kind of the game is like, how do you find money transmitters when maybe the country doesn't even have a definition of a money transmitter? Like the United States, it's very clear who has money transmission licenses or, who has a sponsor bank. If you go to a country where there is no notion of a money transmitter, you start to string together all these different entities. The more developed it is as a country, the easier it is to define like what is essentially the money transmitting entity, whether it's a bank, an EMI, a money transmitter, money services business, you name it. In the harder markets, you basically have to piecemeal the different functions of a money transmitter: the conversion, the delivery, the compliance check, the maintenance of the underlying fiat account. And yeah, that maybe is the game that the market is racing towards right now.
Hey everyone, I'm Andrew on the enterprise research team at Messari, and this week we have a special edition of our Unqualified Opinions pod as we release our State of Stablecoins report. Today, I'm happy to be joined by Arnold Lee of Sphereet Labs. Arnold, thanks for joining me today to talk Sphere and stables.
Of course. Thanks so much for having me. Super excited for this.
Awesome. It's great to have you on. Sphere is one of the contributors to our stablecoin report, so we will be able to talk about the few data points you guys brought up in your slides later. But first, I figured, why don't you go through and explain what Sphere is and what service it provides to customers globally?
Yeah, so Sphere is a cross-border payments API and general platform. What we do is we help you move money from country A to country B faster, cheaper. And, relative to maybe other stablecoin fintechs or stablecoin orchestrators, where we differentiate is we sit both on top of the stack as an aggregator and also below the stack, borrowing from some techniques in BaaS to basically customize the correspondent funds routing. And long story short, I'm sure we'll get into the details. This allows us to handle more complex payment flows, and it also allows us to settle the payments faster. The 99th percentile of payments submitted before, call it for USD, 3 p.m. is within 2 hours or same day. And we pride ourselves on being very quick. Separately, if we put this all into the umbrella of Sphere Pay, we're simultaneously working on a private Solana cluster in collaboration with Onza, which we call SphereNet. And so the general idea is, how can we leverage the properties of blockchains that we really like? That is to say, you have this canonical log of events that are cryptographically verified. And then how do we embed the usual, call them obstacles for an emerging market fintech to really, use stablecoins as a form of global settlement? And this could be anything from embedded compliance to, making it easier for reporting, making it easier to pass along blockchain data to a banking partner, a regulator, or an auditor. And so excited to touch on that a little bit as well. But broadly, both of these fall under Sphere, Sphere Pay and SphereNet. Yeah, I'll pause there. We're pretty active in emerging markets, mostly B2B for fintechs.
Awesome. I've heard you speak on another podcast. I think it was a LATAM focused one. And I've heard you and others describe this general payment flow as a stablecoin sandwich. Can you describe generally how that works and why that might make sense for an end user in an emerging market? And as you touched on, maybe just is this mainly a cost thing? Is it speed or access? Why are people flocking to these solutions? And is it a combination of those advantages?
Yeah, it's a great question. I'll talk a little bit about the sandwich first. And then in order, it'll probably help define the profile of who wants stablecoins. So, for crypto natives, stablecoin on and off ramp are common terms. You pay with a card or you do a bank transfer, you send fiat regular money to someone, and then you get a stablecoin or maybe Bitcoin or a different type of crypto in return. Vice versa, if you're off ramping, you send Bitcoin, ETH, or a stablecoin to someone, and then you somehow get the equivalent minus fees in your bank account. The idea of a sandwich is to basically combine the idea of an on-ramp and an off-ramp. So for someone who doesn't know what a stablecoin is, maybe they don't have a wallet, maybe they're just broadly unfamiliar with digital assets, they can still inherit the benefits of using a stablecoin through the sandwich, which is to say that they send fiat money and it gets converted to a stablecoin. That stablecoin is then transferred around the globe basically instantaneously, and then it gets off-ramped locally. And the reason why this is more efficient is because this is essentially an alternative to Swift messaging, where a Swift message would instruct correspondent banks plugged into the Swift network to move funds between each other. And usually that takes a lot of time because a Swift message will first bounce from the sender country if there's an intermediary bank along the way, which is often the case for an emerging market where the local infrastructure may not be as robust. Then you add that country's own compliance requirements. Could be on a different time zone. Sometimes the routing is just not obvious. A payment from a neighboring country to another in Africa might first bounce to London and then New York before actually settling in that neighboring country in Africa. And so the idea is rather than go through this system that was formulated in the later, or I guess the start of the second half of the 20th century, let's use a stablecoin or a proxy dollar account usually instead. So if you send a stablecoin on like an Ethereum or Solana or Tron or pick your favorite, it ends up showing up to an account on that blockchain a lot faster. And this is advantageous because now you don't have to wait the T+2, T+3, T+5, 10 days that is typically required for a correspondent fund movement, especially within these emerging markets, which tend to have trickier corridors. And now the problem basically becomes, how do you go from local currency into a stablecoin or vice versa? It is super advantageous though for, call it an emerging market fintech, broadly, because they don't really need to get up to speed with crypto. They get the faster, the cheaper settlement, in addition to general dollar access. Stable coins can represent USD, they can represent Mexican peso. There are all these different real world assets that they could represent. Most oftentimes, though, the currency that they have the hardest time getting access to is dollars. And it kind of makes sense, if you are an emerging market, you probably want to strengthen your own local currency. And so it's advantageous from a monetary policy perspective for you to limit access to dollars. But if you are on the other side of the spectrum and you're, an individual or a business trying to touch most of the developed world, it's super convenient to be able to have this proxy for dollar accounts. It allows you to, increase your business much more rapidly. And so maybe you could start to get the hint that stablecoin sandwiches are great because people don't really need to do the learning curve, so to speak. And it's just faster, it's cheaper, and everyone needs to send money around in order to do business in an increasingly globalized world. I'd say that to kind of dig into your second question a little bit more, though, why people want stables really depends is the unsexy but true answer. That is to say that, it could be relatively their country has very strict restrictions on dollar accounts. Maybe as a geography, they happen to do much more cross-border trade. As an example, you can imagine, a canal or call it strategically located countries to bodies of water maybe that you need to pass through for goods like oil, for gas. It could even be agricultural staples, end up just doing a lot more cross-border trade. Or maybe they're just surrounded by a bunch more countries relative to one that's more isolated. And so there it becomes in aggregate a much more compelling value proposition because they start to save so much more money and time since they're already doing this cross-border trade anyways. If you expand this profile, individuals might want USD access, not even to send it outside of the country, but because USD as a store of wealth is better. It depreciates less than other currencies because it's the world's reserve currency, used in 90% of global foreign exchange. Most commodities, most derivatives, most assets are denominated in USD, which gives it pricing power. And so once they get the stablecoin, some of them decide to realize yield that stems downstream from treasury bills, which is kind of within the mechanics of the stablecoin, how these proxies are minted. You warehouse treasury bills, short dated, cash equivalents, and you mint a token on a blockchain to represent that security. But from the perspective of an individual, this means that they can now take that minted stablecoin or token and put it maybe into DeFi protocol, or maybe invest it into, call it a proxy broker dealer who's offering exposure to stocks. It could be compounded versions of a T-bill, essentially adding more leverage to get more juice out of the underlying instrument. Maybe you lock it up for longer. We see that use case pretty often as well, which is to say that, maybe if you're in a given country and you're not that bullish on local municipal bonds relative to dollars, you might want access to dollars because now you can start getting T-bills from the States, as well as other assets that are, again, conveniently denominated in dollars. Those are the usual suspects. I'd say that there are some uncommon reasons why people want stablecoins. it's a little bit underaddressed, but I'd say that it's a very convenient tool for bad actors. And naturally, this increases the, call it, requirements or a need in order to make sure that compliance is correct on chain, because you probably don't want like a really bad country, a rogue state, a terrorist organization to get around sanctions or money controls. I'd say that in another weird use case, the fact that stablecoins are a more efficient unit of account. So even if you're a cross-border payments company like us, even if you're like a shipping company and you're used to denominating assets in like gold or oil or some harder to store, harder to move around, call it currency, stablecoins end up being a much more convenient way for you to directly debit and credit with your counterparties, and also use it as a collateral to get credit. And I guess TLDR, because I feel like I'm starting to say a lot of words, is that you see the whole spectrum of stuff. Happy to dive more into maybe like the weirder examples, but whether you talk to a retail user or a company or government, the maybe benefits or advantages tend to, you start to see similarities.
I think that was a great primer, and it basically covered a lot of the major sections of our total like completed report that's coming out this week, namely like just dollar access, financial inclusion, cross-border payments, even just regular e-commerce now as e-commerce websites like Shopify are starting to integrate. Going back to a few things you said, like on the access side, something we found like that's very like underrated, I would say, for these countries that have very limited access to dollars. I think right now you can get, like if you're in Argentina and you go to a peer-to-peer marketplace, you're getting upwards of like a 5 to 10% premium on your USDT just to go back into local currency. So there's a huge premium to like having this alternative rail and getting access to dollars outside of traditional, maybe not regulated, but more traditional ways like arbitrageurs and even just local citizens don't have access to dollars that as they might be restricted by whoever their governing body is. And then on the outside of access, I wanted to follow up on, you made a very good point about as I did this report, I learned a lot about the correspondent banking system and how some of these banks, where if you're hopping across borders, they might all be on Swift, but they don't necessarily have partner accounts with each other, and then you have to go through an intermediary. And those intermediary fees are really where like the percentage cost of sending a payment starts to rack up incredibly quickly. Because as far as I know, and maybe you could detail this a little more if you have any more insight, but like those correspondent bank fees or whoever's are intermediaries, it's usually like a flat dollar fee, right? Like if you're hopping between them, and then say you're sending $200, you might end up spending like 5 to 10% trying to send someone money across borders. Is that accurate?
Yeah, Citi did a study of this globally. Average remittance cost is about 6% for a cross-border payment. And, in the harder corridors, it could be like 10, 15, 20% plus. For the harder currencies, it could be much, much higher than that even. And you're right that like if you examine a Swift message, it identifies a fee. It is entirely within the onus of the bank that is processing that Swift message to set the fee. Right. So if I send you $100 and our banks are particularly, in need for liquidity, it might show up as $5. There's no like theoretical reason why that couldn't be the case.
And as the payee, like you don't actually know what you're going to receive by the time you receive it necessarily.
Yeah, banks, I think try to be reasonable, but there is variance in how much you end up getting. And I guess like the beautiful or terrifying truth is that no one really knows. You can start to build like an empirical sense of what the fee is probably, but no one really knows. We've heard stories about, like even at a bank, the employees might not know why exactly the wire fee is like $7. Maybe the real cost is like $3. And then one day someone was like, we should charge $7. Yeah, there's like an inheritance of this information that is quite big that has resulted in, a lot of these inefficiencies today.
Right.
Yeah, a lot to say there, but, I don't, we might start getting into like wire room lore. So I'll pass the mic back to you.
That's okay. Yeah, just touching on that, I think that remittance fee statistic, like, that the World Bank's done multiple studies on averages across the globe of how much it costs to send $200, and it's somewhere around 6%. And as you dig into that, maybe 4% of that is coming from the actual transfer fee charged by perhaps by the sending bank, and then there's like a 2% FX markup perhaps on average. And what they note usually in all of these studies is that they don't include extra layered on intermediary fees because they're very opaque, and they're empirically kind of hard to track and get data on. But like, you're sending $200, and some 10 to 15% or maybe more could get layered on there. And so obviously this stablecoin sandwich flow is an immediate, I would say, improvement upon at least this legacy system. Can you explain, within the Sphere Pay flow, how do, say, we have that 2% FX markup that's usually there? Does that compress? Does it disappear? Where is the liquidity getting sourced from when we're going from fiat to blockchain rails back to fiat?
Yeah, it's a great question. Generally, I do believe there will be compression on fees. Like, if you really break it down into the Elon idiot index, like, what are the actual raw input costs to do a cross-border payment? There are some more like subjective ones. What does it take to get a license? What are the minimum capital requirements? What's the going rate for someone who has to manually do work today? Maybe they're reviewing KYCB. Maybe they're actually processing a wire. Maybe they're like sitting on hand just in case something goes wrong. If you assume that a lot of manual work starts to improve over time, technology gets better. It's kind of crazy in 2025, like, AI is getting a lot better. And so maybe some of these manual tasks we thought were previously probably impossible to automate start to go away. But I guess, like, if you take the maybe negative approach, or like the negative view, like, why wouldn't they compress? Why don't the input costs get cheaper? And it's hard to say why they wouldn't. As like an economic good, the stuff is like increasingly becoming commoditized. It's a homogenous good. You can reuse payments infrastructure over and over again. That's sort of the point. It starts to become hard to differentiate between, you swipe your card, say at like McDonald's. Are you using Stripe? Are you using Shift4? Who really knows? Maybe that's the point. So like, maybe a summary view is that probably it compresses to a point where just barely service providers are willing to come in and provide that, actually do the money transmission for a cross-border payment. A lot of the backend infrastructure, I think, starts to trend towards maybe what could be best described as like a charitable or public good. Same way that like a lot of internet protocol standards went, HTTPS, TCP/IP. Of course, there's a little bit more manual work for cross-border payment than what you need to receive packets, say on a web server. But on the foreign exchange side, what people do today, it's worth thinking about, like, where is FX actually inefficient? And I think we sit squarely in the middle of, I'll call it like the Web 2 and the Web 3 worlds. Core team started as pretty crypto native, and we increasingly added more folks from, call it like traditional payments. And so it's fascinating because, it makes sense why no one has a complete picture. On the traditional payment side, I think it can be a little bit hard to understand some of the technical details as to why, you end up making ledgering just more efficient. Or, this idea of a stablecoin, which is kind of violates previous definitions of money. It is simultaneously a form of payment, but it's also yield bearing underneath the hood because there's like a T-bill or security backing it. Maybe nuances like that are a little bit harder to grasp, as well as the variations within chains that end up mattering. How you settle on Solana looks very different from how you settle on Ethereum or on Tron. And maybe on the crypto side, I think there's maybe this meme that like banks are just evil. Banks are bad. People work at banks. Not all, JPMC has like 300K employees. They're not all evil, and I think like from an incentive perspective, what are banks? In some sense, they're a way to drive the economic engine within a country. You put money in, that money gets used to lend to other people to build businesses. And so in that sense, it serves like a public good. But the banks themselves are private entities usually. And so they now have a profit incentive to make more money. And the way that they make money tends to stem from the fact that their deposits sitting at the bank. So even if you assume the best intentions within, a bank's employees, the truth is that structurally there is like a benefit to holding money for the bank, including delays on the payment. And over the time, these start to compound. So maybe like that binary on both ends is kind of why there's a gap. Neither like all crypto activity is evil, not all banks are evil. And really probably the correct answer is that it's worth thinking about where the idiot index for both trends to, just from like a physics perspective. How do these nuances between chains, how will those converge relative to how does the manual labor within a bank converge? And I'm setting all this like pretext maybe for my direct response on the foreign exchange question. Hopefully the listener, as well as you, Andrew, will start to see how it completes the circle, so to speak. USD Euro are like very efficient foreign exchange markets. There's kind of like no reason to put it on chain. Maybe from like an availability perspective, an inclusion perspective, turns out that, at least as of the world today, it probably does cost a retail user more money to like exchange USD against Euro versus just getting intrabank from their bank. But if they don't have those accounts to begin with, maybe that's the best they got and something that they have to bite. If you look at like long tail fiat currencies, though, a lot of those currencies are not efficient in foreign exchange markets today. And it's for a whole host of reasons. Maybe it's just like the fiat currency is down only. And so like no one really wants to hold the spot. Everyone's just shorting it. So like, why would anyone hold it? And therefore it's hard to create a liquid market around it. Maybe it's like no bank, including the cities, the B of A's, the JPMCs of the world, are allowed to hold correspondent accounts in a given region. Maybe those countries are on bad lists, or geopolitical relations are off. And so bringing those types of assets on chain that problem is quite interesting, because there's a paradox. These are some of the hardest markets to operate in, and yet they have the direst need for stablecoin representations. So how do you go into a country and get access to these currencies, guarantee these currencies? Because if you really like think about it from first principles, stablecoin issuers are kind of like regulated entities that make a fundamental promise. You come to me and you give me the token that I gave you, and I'll give you dollars, and vice versa. In markets with weaker rule of law, that's harder to enforce. So, if you go to call it like the top half of countries in terms of development in the world, usually there's a robust enough legal and operational infrastructure for people to implicitly or directly touch foreign exchange markets. And then, market makers, whether they're like actual trading firms or, banks or money transmitters or something else, they basically come in and provide liquidity and make money by making that market. On the bottom half development index, call it, it's much harder for market makers to step in. And there's no real great answer to people moving in and out of local currency. Usually these start to form like gray markets, peer-to-peer, and it's almost like a very inefficient CLOB or central limit order book, where like you are basically aggregating the opinions of the people around you, and someone is willing to give you, call it 10 USDC for, 100 kwanza. Next guy is willing to give you, 90 kwanza. And so it's almost like a barter and trade economy. So hopefully that kind of like answers your question on FX. Usually it'll go through an exchange or a market maker, whether it's first party or third party kind of makes a difference. The quality of the currency also makes a difference. And usually countries have like particular rules when it comes to capital controls, like how much are you allowed to move out per day? What is the stability of the bank that you're moving in and out of? What is the general political stability? Will the rules change next year? But in other countries, it ends up basically becoming barter and trade, much less efficient in how you get in and out.
Okay. So along those lines, say as a orchestrator on the back end, when you're routing, say, Mexican peso to Argentinian peso, since you guys aren't actually a money transmitter, who's taking on or like warehousing that's the conversion or like FX risk along the way, and like who on the back end are the entities you're connecting to essentially?
Yeah, kind of the game is like, how do you find money transmitters when maybe the country doesn't even have a definition of a money transmitter? And like the United States, it's very clear who has money transmission licenses or who has a sponsor bank. If you go to a country where there is no notion of a money transmitter, you start to string together all these different entities. It could be OTC through like a formal or an informal market maker. Perhaps the bank provides one leg. That bank belongs to your customer. This is kind of like what I described at the top of like more complex flows, because sometimes it's not very clear cut who are the entities in the chain. For example, in one large Latin American country, our client acts as a vendor as well, in some sense. We're not taking on direct FX risk because kind of his business is to take on the direct FX risk. He has a local, call it peso account. He can hold spot. He has access to a local broker dealer. Therefore, he can hedge it. And he kind of handles the problem of the local currency, at least into stablecoins. The problem that he might run into as, say, a non-English speaker with non-English documentation is it might be very difficult to convince a money transmitter for USD or for Euro to onboard him and to basically give him the support that he needs to robustly send size in and out of stablecoins into dollars and vice versa. So the more developed it is as a country, the easier it is to define like what is essentially the money transmitting entity, whether it's a bank, an EMI, a money transmitter, money services business, you name it. In the harder markets, you basically have to piecemeal the different functions of a money transmitter: the conversion, the delivery, the compliance check, the maintenance of the underlying fiat account. And yeah, that maybe is the game that the market is racing towards right now, especially in Latin America, at least as of the last year or two.
Okay. So would you say Sphere pays like, and more broadly, these stablecoin infra companies, are they kind of just better at reorganizing who warehouses some risk at some point? Or because you mentioned the banks are like, obviously they have a massive regulatory burden, which can sometimes probably affect the price they're pricing these services at. And then two, it might be just very unattractive to provide liquidity in some of these long tail markets. Is Sphere as like an orchestrator, is that the primary benefit of these infra companies, like connecting the OTC people who are willing to provide liquidity, and then also kind of taking in all the information around who the payer is and who the payee is, and lining up the most efficient route? Is that, would you say that's like a good description, or is it something else?
So primary is an interesting question because maybe I'll make two comments and then hopefully get an answer to you whether it's primary.
Sure.
Um, in general, I'd say like risk is the premium that's being paid. Like spot on NASDAQ is like pretty efficient. Spot on chain is like pretty efficient. Where companies can really start, or protocols can really start to price discriminate, is on risk premia. Like, do you trust the underlying exchange? Do you like the UX, right? Like, so will you come back, bring liquidity, increase open interest, and each type of exchange will have a different flavor of how it charges you. Maybe there's an execution fee, maybe there's a maker taker fee. These all like vary. Maybe there's a rebate. And the same way that it's like kind of impossible to say, is Robinhood Gold like actually worth $5? I'm not really sure. Like versus $3 versus $7, I'm kind of paying what I think probably is worth it for the subjective experience of trading on Robinhood. Over a year, is it actually worth $60 to me? I don't know, but it's like negligible enough where I'm willing to bite that cost. When it comes to stablecoin orchestrators, it's kind of a similar story. A little bit less like hard hitting though, as compared to retail trading. That is to say, you're fundamentally paying for the labor that is being used to find the best partners, whether it's like the stablecoin issuer. So, maybe there's a bias towards Circle versus Tether. It could be the banks that are involved in the chain. It could be the liquidity providers provided in the chain. And so there is a sense of art to it that coheses into which orchestrator stays on for the longest, is the cheapest, and is the fastest, who provides the best customer experience. If you zoom out though, like a lot of these, I think differentiators go away with time because so much of the back end is commoditizable. When we talked about retail trading, it's like hard to commoditize like the emotion that you get when you sign up for Robinhood Gold and then you get confetti, and it's just like super easy to like trade stuff. On the payment orchestration side, it becomes a little bit easier to like kind of nail down, hey, like this is the average cost, this is the percentage of payments that go through and that don't. It becomes a little bit easier to map. I'd say, despite that though, since we're on this topic and it might be interesting to the listener, something that's like really hard to wrap one's mind around is maintaining the aggregation. It's a very nascent industry, and so like oftentimes APIs will break, someone gets kicked off their bank. Now you have to rearrange the whole flows or like hope that they'll do it well for you. And because the regulatory and call it like bank openness environment changes constantly, maintaining these integrations can be quite frustrating, to be frank. From a tech debt perspective, engineers in the audience will, maybe feel the pain of having to like refactor something that was, one way, day one, and then call it day 30 is now completely different because the underlying bank has changed. creates all sort of dependencies that you now have to go back and fix. And it can feel like no progress is being made, but simply maintaining, we've invented a new type of rocket ship, maybe is the best way to think about it. And no one really knows how to, 100% perfect build it. The parts are coming from vendors who may not be there the next day. And so you need to figure out how to tape things together the best as, the rocket ship starts to break up or, certain vendors go out of business. If I go back to the first point though, zoom out, this inefficiency eventually goes away too. Regulatory clarity will come, banks will become much more familiar with the technology. Who knows on the time horizon? Maybe it's weeks, maybe it's months, maybe it's years, maybe it's decades. But from first principles, there's no reason why it shouldn't eventually go away and kind of be maybe a segment for data analytics or Hugging Face for AI. These are more, call it anti-fragile examples of API orchestrators, just because the underlying APIs have been around for longer and are less dependent on volatile, call it macro conditions, like whether banks in that country are cool with taking in stable sourced funds or not. What is the primary thing that orchestrators like Sphere, can add value in terms of? Short term, I think the above answer is probably correct. In the medium to long term, I think what people don't spend enough time thinking about is okay, beyond just the settlement, beyond just the fact that the money showed up faster in a different country, what other benefits are you creating? Is it literally just that? Because that's an interesting contrapositive. Today, maybe you could describe it as order flow, but one of the most fascinating things to me, being in, going to the customer over the last few years, is this is for these countries, once in a country, I don't know, maybe you could call it once in a civilizational level moment of change. Africa, is infamous for kind of skipping the desktop moment and just went straight to mobile. In places like LATAM, why did stablecoin adoption increase so much? It's a lot of factors, of course. Favorable regulatory environments, maybe in absence or due to absence of action. Millions of people not just getting internet for the first time, but getting good internet access. And so there's the flywheel of people starting companies, and people can start to do e-commerce and fintech and all the other components of an internet economy more. But if you really slice down to it, there's a lot more information now about areas of the world that were previously dark. And that's a very interesting place to be. Anything from KYC, identity is sometimes non-existent. I can't tell you the number of people I've met in certain countries that just were never given a passport or a birth certificate. To their purchasing habits, to the movement of money in real time. To give you a real life example, in February there was a back and forth between President Trump and the president of Colombia. And there was some uncertainty on what the tariff outcome would be for Colombia. It was fascinating for us because in real time, faster than any news outlet, faster than any traditional foreign exchange, call it venue, marketplace, we saw money move out of Colombia because people were trying to hedge their bets. Massive, flows into, call it stable coins. And as things started to cool down before any news articles came out, we saw vice versa, money moving back in. And so I think, without giving any too intense alpha, just because I assume someone I compete against will watch this, God bless you, that's probably worth thinking about too. As the, idiot index continues to compress to zero, where are those moments of, call it price discrimination? Where can you make that charge? And to us, it's most interesting when it's net positive or net new. Concrete example, let's more identities, spending on things. Honey, is an example of the United States of where they were able to monetize this. But I think that's just the tip of the iceberg. And the next game, if the previous game was how do you string together all these different providers to create a definition of what, in the US we would call money transmission. The next game will be, how do you figure out how to sustain a business on top of, a product that fundamentally is compressing to zero in terms of its margins? And where are those net new opportunities for you to be able to charge that delta in margin?
That makes a lot of sense. So going forward, as this space sees more and more new entrants, and we see those fee compression where it makes sense as the market just gets more efficient. But obviously, once you've been aggregating and kind of orchestrating these large payment flows. There's a lot of valuable data in there on consumer behavior and consumer spend. So that makes a lot of sense. I could probably segue this a bunch of different ways based on what you just said. I would like to know more about the customer base. As one thing you highlighted in our report was that enterprise adoption through Sphere has been much higher than the peer-to-peer side. Do you have any direct interaction with some of these businesses? Do they tilt towards any sectors or categories? I think a lot of people would kind of want to know about who and what businesses are actually using these services, and how come they had to go to this new solution as opposed to whatever exists in their current country.
Yeah, so much to say there. So much to say there. I'm trying to think, because this is a podcast, like what is smart for me to say?
Okay.
Because it's like when you FUD something on CT, right? Like if you're FUDding hype bags, call it, even if there is a fundamental problem, maybe it's not like the most intelligent thing for you to proclaim to the world. So maybe I'll talk about like the lit things more, and the readers can listeners can kind of read between the lines there, because so much of the hype isn't necessarily lit. Customers are pretty easy to describe. This could be. I'll give like a couple of examples.
Sure.
I'll start off with a disclaimer. Sorry, disclaimer is that like I learned what an ICP is. For what it's worth, my background is software engineering. A lot of the normal startup stuff I had to learn. So I learned what an ICP is. It's an ideal customer profile. And part of the trouble is that it's really hard to define an ICP for something that like basically either just came out, or like no one like has been out for a while, but no one really knew about, or where there's regulatory clarity for the first time. And so it's a greenfield. Maybe you try to address SMEs. Maybe you try to address other financial technology companies. Maybe you go for institutions. Maybe you go just for consumer. Maybe you go for like consumer apps. Maybe you go for ride sharing apps. Kind of like the beauty of stablecoins is that they're at least 1% better for like almost everything. Now, where are they 10 times or 100 times or 1,000 times better? That's a very interesting question. For what it's worth, we realized that as a team, our strength is probably not trying to sell to like Walmart. Like this probably does sell Walmart money, but now you need to convince Walmart to use it. And it's scary. The biggest ones are like private issuers. It's unclear what the rules are going to be for it. Even Genius like mostly surrounds issuance rather than transmission or all of the extra details after issuance. Reporting, auditing, what liability is. If there's like a huge crash in your usage as, call it, a large corporate player, like what is the end state for you? There are teams that are better positioned to like go and sell to Walmart. There are probably teams that are better to go sell in Silicon Valley. Again, call it Y Combinator, right? The average YC company could probably benefit from stables. Now, is it like a hair on fire problem? I'm not really sure. For certain types of companies, probably. But broadly, I think the trouble that we as a, call it, sub-industry run into is that the meme is so good. Stables are just like objectively better from a ledgering perspective. And so now it's tempting to kind of go after everyone. You'll notice that I'm like not clearly defining like who our customers are. It's because the answer is kind of boring. We serve software companies. We serve fintechs. There are at least one or two SMEs on our platform. We go up. We work with very, call it, large trade companies, companies that happen to do international trade, and the angle in which they're using stablecoins is always slightly different. And I think part of that delta is because we're still all trying to figure out like what the rules will be in 5 to 10 years from now. I've heard, for example, people say, I'm only going to use JPM coin. I'm not ever going to use Circle. Which is like strange because JPMC is kind of like, or JPM coin is like a tokenized direct deposit account. So you can't actually like transfer it to someone who doesn't have a JPMC account. So is it really a stable coin? It's hard to say when we don't have like a dictionary definition or like an academic definition of a stable coin. And so where we find the most juice is like where most people don't want to go. A couple of years ago, it was LATAM. Sphere kind of got into stablecoin land because it was the only thing that really made sense to us. and where like people were excited to talk to us after FTX and call it the Circle DPEG. Back then, there weren't that many folks in LATAM. That's changed a lot over the last couple of years. But it was widely considered a dumb idea to go to LATAM and try to sell to anyone, whether it's an SME or an individual retail user. There were like some exceptions, like Lemon was doing super well still in Argentina, but call it the other countries on that continent or in the general area of the world was not considered a good idea. Now, a lot of them have become more sophisticated, more used to stable coins. And so the opportunities that open up look different. It becomes easier to sell to an institution. It becomes easier to strive for like merchant acceptance from folks who, a couple of years ago just got their first Toast or Square terminal. Nowadays, we again like to think, where do people not want to go, or where does it structurally make sense for people not to be? And maybe like the hint that I'll give is sometimes the best product doesn't win. And, it's fascinating when that's the case. Maybe it's like the argument against wave magic wand and like everyone just starts to accept USDC. Everyone's cool with it. Sometimes like, even if USDC is better, it's difficult to get an incumbent to like care at all about stablecoins because they're worried about how am I going to pay for electricity for 10 million people in my country next year. So that's a very interesting source to start poking around in. But I wouldn't describe our method as the best one. I hope it's a good one. It seems to be not killing us yet. But there are probably better ways, at least to drive margin. That's for sure.
Okay.
Yeah.
So I like the framing as you guys kind of seeking out where there might be some structural edge to exploit just because other players are not in the market and they're avoiding it for some reason. Could you go into the reasons why LATAM, like an attractive proposition at the time? Was it a compliance, regulatory, legal hurdles that people didn't want to tackle? Why do you think that opportunity existed back then, and has it changed a lot since you guys started?
Yeah, from our perspective, it was luck, I'd say. Luck of the blessing and curse is that we got our start as everything was failing. So there weren't that many faces to go and talk to if you were remotely interested in stablecoins. It's not like 100 people reached out to us from LATAM. It was a couple, but it was interesting enough where these are like successful businesses that don't depend on crypto as an industry going up or down. We were like, hey, maybe there's something here. From like an outside of our perspective, I think a lot of demographic factors colliding at the same time. We touched on some of these before, but like internet getting good enough, maybe internet adoption getting good enough, maybe there are political events in the country or a set of countries that make it harder to get dollars. Those factors happening, which I would still describe as luck for us, meant that LATAM was very interesting. I think on Solana at the time, there were like 30 companies left. I can't recall anyone who specifically focused on stablecoins except for us. Maybe there are a couple. That's probably why LATAM. And, relative to an Africa, relative to an APAC, relative to Europe, relative to the United States, I think you can actually do a pretty compelling, call it like demographic or like macro or geopolitical analysis as to like why that was the spot to go a couple of years ago. I still think it's a great region. The people are incredible. I think the appetite for improving, life, growing as economies is incredible. The culture is so warm. I'd say that like the number of entrants has increased for sure. And so while the pie has gotten bigger, so are the number of people like splitting up the pie. So I think still a very good place to go. The heuristic that I like to use is would a really smart, cracked out, call it engineer from MIT want to move down to call it Panama and just live there? I don't think so. That's probably still true. And that heuristic is a decent test of where there's still juice. Not a bad idea to go to LATAM, but without kind of digging into it and being willing to make that decision that I just described, I would be cautious because the market is just different. The culture is just different. And we've noticed that maybe in the last 12, call it 18 months, thinking about other regions of the world too. Places are just different. And the trade-offs might not be as clear cut as, in California, getting a LinkedIn DM and comparing your enterprise HR platform versus another. Then it's just hey, we should use A versus B. In certain markets, like the inputs going in towards a business decision might look very, and sometimes scarily different, or uncomfortably different for a would-be entrepreneur.
Okay. I think a good point you made there and beforehand, not pitching stables as this kind of cure-all that's just better in every scenario. Like there are probably a bunch of situations or circumstances where the marginal improvement either might not be that great, but then in other locations it's like an order of magnitude better. One thing I wanted to ask was, as there's more entrants and there's also other methods now that kind of have increased efficiency across the board. When you look at other payment service providers, maybe like Wise or neobanks that are kind of getting into the space, like Revolut, where you can do these cross-border payments, and say they charge, somewhere around 50 or like 0.5% or so, as opposed to maybe the normal markup of 2%. What would you say is the difference between Sphere and some of those providers or services? Do those work in certain locations better? Um, or how would you differentiate yourselves?
Yeah, it's so fascinating. When a large player does something, I'm the same way for what it's worth. When like OpenAI does something in AI, I don't know that much about AI. I'm like, oh shit, that must be bad for perplexity or something.
Right. Just
That's that.
assume.
Yeah, like I remember the meme a year or two ago was that like ChatGPT just killed all the ChatGPT wrappers in YC, and then Cursor became an $8 billion company, and Windsurf sold for a couple $1 billion. So I have increased skepticism, maybe, of call it, what do they call it in startup land? It's like innovator's dilemma. There we go.
Hmm.
Sorry, I'm still learning this stuff. I'd say especially within a regulated industry like payments, like finance, being small is sometimes the most unfair advantage that you'll ever get. So, like, what is the difference between us, call it a Revolut, a Wise? I mean, they're bigger. They have way more coverage than us. They support way more currencies than they're us. Their front end is probably better. Their back end's probably better. But they have a lot more people. Those people tend to live someplace and speak some language, and there's usually like a concentration, a heat map. There is one parent entity. They might have a bunch of subsidiaries, but that parent entity is governed in a particular way, and it's now governing thousands and thousands of people to all follow one size fit all rules. So I'm excited when a Revolut or a Stripe or Airwallex. I for what it's worth, I do think that like the stablecoin maxis, and I love them. They're pumping my bags. I think it's like a little unnuanced when they say Airwallex should just adopt stablecoins. Of course, they believe that. That would probably help them more than it helps Airwallex. But so I feel for Airwallex. But I'm generally excited when incumbents start to adopt stablecoins. And I think probably the most unfair advantage that we have, and I hope that we continue to have, is that we're small. And so the margin that we need to charge is lower. Our ability to enter new markets is easier. With a nascent technology, it's much easier to correct the course of a ship that's very small relative to a ship that's very big. And if I'm making, call it $10 billion a year, and I now am making $2.5 billion a year because stablecoins made my payment costs 2% and now they're 50 bips, that's going to cause a lot of problems. Maybe you have to start firing people, and maybe they sue me. Maybe like some important people got fired accidentally. Maybe there's like code that like a guy knows super well. We accidentally let him go, and now no one knows how to debug it. Maybe there's like a key regulatory relationship or bank relationship that someone used to have and now no longer has. Yet I could talk about this one for hours. I just like maybe summarize it for everyone else's sanity as the biggest advantage is being small by far. It almost makes me want to stay small because it opens up the potential impact that you can have. But overall, it's good for everyone if corporates, large players start to adopt stables. For most retail users, Revolut plus stable is probably better than Sphere plus stable. But it would be pretty crazy if that were the way for everyone. A concrete example. The way that pre-funding models work and how these fintechs operate is that like it's super hard to get like size through these platforms. Airwallex is better at it, but like if I'm Wise and I hold like 50 mil PHP in spot in the Philippines, like I'm probably not the best vendor to go to if I want to move 50 mil PHP, USD equivalent, of course. And it's in those gaps where new entrants can come in and help fill them in, which starts opening up the flywheel for new types of maybe directions for international trade and call it economic activity. Hopefully that kind of answers your question. I know it's a little bit of a indirect one, but I like relative to other people, even including on my team. I'm sure Augustina and others listening to this could attest to it. I like truly don't care that much if like a big company announces that they are doing stables. That makes me pretty excited.
Yeah, I totally agree. And I think a lot of the consensus reactions around even this, the signing of the Genius Bill, I've heard similar refrains of, oh, like JP Morgan and their tokenized deposit. Why would I use anything else once JP Morgan is involved? Or, along those lines. And I agree. Being small has huge advantages. You can kind of sense that there's been a lot of organizational inertia among more traditional firms. I don't think a lot of them were expecting to get this regulatory clarity this quickly, and now they're kind of scrambling. They're like, oh wait, we actually have to do something around this because all of our clients are asking if we're going to be involved in this kind of mega trend. I think you even saw that, recently, I think on Citigroup's last earnings call, they mentioned attempts to, get into the space, and you kind of tell they're a bit surface level. They're like, oh yeah, we might go into crypto custody. We were probably going to launch our own stablecoin, and just it feels more like haphazard planning and maybe a little more theater because I imagine in an organization that large, they had to wait for regulatory clarity to do anything really, and now it's tough to take action on something in a space where you need a lot of domain expertise. You need to have been working on these problems for years, as you guys have, and other teams like I would say Stripe has been kind of pretty heavily involved this entire time and very attuned to what was going on in the space. So yeah, that framework makes a lot of sense to me. Beyond, say, this recent regulatory clarity and new entrants coming into the space, is there anything else on the horizon that you're excited about or you think is going to move the space forward in general?
Yeah. In isolation, this might sound like a schizo post, but I think that, encryption on the internet in general, mobile, not too long ago in our lifetimes could have been considered schizo posts. ChatGPT. I think a lot of people are going to have to like think about, what is a company? Like, it's a pretty recent invention. Like, why do companies exist? What are they supposed to do? You've hinted on some of like the structural reasons why incumbents are moving slower, and it might be considered like marketing psyops. If the purpose of this technology is to fundamentally streamline interactions between two different, at least sovereign, call it nations, an entity by definition is attached to one sovereign nation. It has to be registered somewhere. It has to do business somewhere. And, we have this idea that like companies are normal, the fiduciary legal like duty to like maximize shareholder value is like a pretty normal meme. But what if there's a technology that just makes everyone else less money, like everyone, including yourself, less money? And I think it's worth thinking about, well, as a shareholder maximizing, call it like collection of people building things, tools, software, whatever it is. How do we reconcile with the fact that like kind of the whole point of this is not necessarily even to cut down our own costs, but the race to zero for any type of ledgering between people who couldn't trust each other before compresses to zero. I'm very excited about that because I think it'll start to challenge our notions of like, what is the point of building a company around stablecoins? Like, what is the point of, charging more margin than you could, which is kind of like historically seen as like super good, right? Like if you ask a kid from YC who went to like Stanford, they're trying to make a super valuable company that provides an awesome service, and they're going to charge a fat margin on top, and they're going to probably, maximize shareholder value. that same company and its competitors might start adopting stablecoins. They'll realize that the ability to price discriminate in certain respects is going down significantly, not just because the ledgering efficiency is better, but because the discoverability is also programmatic. And so now I can kind of use whichever issuer or money transmitter, broker dealer, whatever it is in the world that is offering the service at the best possible rate. I think that'll be quite fascinating and push, hopefully the species forward. Maybe the same way, again, it sounds super schizo. Look at Twitter and LinkedIn, all the social media channels where AI is now causing people to question like, hey, like, should I go to a therapist or should I talk to ChatGPT? Should I, is this like a new type of like outlet that like just couldn't exist before? There's like personal, maybe you could describe it as spiritual reasons why I think it's interesting. There are like concrete economic reasons why I think this is super interesting. New markets will now become viable because this stuff is all super abstract unless I give an example. My co-founder is from the Bahamas and like the TAM's 300K. So like, why would you go to like 300K people? Like, and there's not a lot of natural resources. It's mostly like a tourism driven economy. So like, why would a Stripe go and like put in the effort to really service the Bahamas as well as they service the United States? Like that incentive kind of isn't there. But if margins have been compressed to an extent where like, people have lower opportunity costs in entering some of these markets, now that calculus has fundamentally shifted. And maybe it starts to make sense for a Stripe to go and service the Bahamas because the barriers of entry are not only lower, but by comparison, they can't make as much money, targeting, call it developed markets. So yes, hopefully that kind of answers your question.
I like the contrast. I guess as a follow-up, if you think this stablecoins as a technology are kind of this positive force that are and the efficiencies it opens up creates just a lot of new opportunities that cause people to question the current way of like this profit maximalist way of creating value. I see that as kind of diametrically opposed with, as you mentioned earlier, some of these EM countries who want to have control of their local currency and their monetary policy. And it's kind of like at some point, if stablecoins are super successful, as like most of us think they will be, what do you see happening there as this like force for good meets the incentives of governments who kind of need to control their local currency, and you have local citizens kind of off-ramping constantly into dollars, just a better form of savings? Do you see that kind of escalating or climaxing at a certain point?
Yeah, it would be a good answer to like the opposite of the question that you just asked, which is like, what are the things that I'm excited for? I think like the industry is not really thinking about this stuff kind of because it's bearish and like who wants to think about bearish?
Yeah, precisely. I'm trying to balance out the mega secular bull trend.
Yeah, you're doing God's work. No, yeah, I think that's one of the most important things that we should all be very careful about assuming. I'm American. I love America. Founding fathers were geniuses. US dollar hegemony is like kind of taken for granted as like a good thing in America. Western values are considered superior. I don't know across what dimension. Maybe you could like describe it secularly, and democracies go into war less often with each other. Maybe you could describe it from a values perspective, like equity, justice. Like there are these like common moral intuitions that we believe are good and are better expressed by democracy. That said, I think like cultures are different. If I learned anything over the last few years, and just because the U.S. dollar is the best place to park your money in many ways, and so much of the world has been like the world's history has been written with the dollar in the last 100 years. I'd be very careful with the assumption that like we should just let everyone move freely into dollars, and I'm happy to elaborate maybe through a couple or one concrete example if you want. But yeah, imagine there's a country. I'll choose a less scary one. The scary ones I'll leave as an exercise to the reader, listener. But that's really where I think the industry should spend a lot of time thinking about. A less scary one would be like in Argentina, kind of a hyperinflation, rising amounts of debt. Milei comes in, super charismatic, wants to do things differently. Tether as a meme is like more commonplace for retail in Argentina. I think it's a little exaggerated, but certainly compared to like a Detroit, people use stablecoins more there. Ours, Argentinian peso, is not dollar backed. If it's super easy to move from Argentinian peso into dollars, now the local government is able to conduct monetary policy less effectively. Now, what does that mean? It means that what does the government fundamentally pay for? Like, what does it print to pay for? It might own sovereign debt in other countries. Other countries might own sovereign debt in it. It probably pays for public infrastructure, hospitals, schools, police, like the whole stack of important public goods that we probably don't want to be privatized. We probably don't want privatized militaries and the recreation of fiefdoms, feudalism. So now if the Argentinian government and ours is depreciated, can't really fund those things as much anymore. It's harder to attract, and it's like a negative feedback loop. Like if ours is depreciating and they can't invest in local infrastructure, it's now a less attractive opportunity for foreign direct investment. It's a less attractive commercial opportunity for, call it, people both domestically and internationally. Now, what choice does Argentina have? It's not going to suddenly convince the rest of the world that it's a better counterparty than the United States in its dollar. It could choose to become dollar backed, and a bunch of countries have done this to various levels of success. Singapore, Hong Kong. But if you're dollar pegged, now your fate is kind of more dependent on what the Federal Reserve does, which is an unelected board of really smart but I don't know, single digit, double digit people. So now the fate of millions of people in a completely different context, different physical geography, different culture, different needs. Maybe they have a ton of bananas and they don't have a ton of metal, as a throwaway example, is being decided by people in DC who probably have never lived in Argentina seriously before, don't understand the culture. I'd be very careful with the assumption that let's just get stable coins everywhere. And USD stable coins are very good. I'm, a huge America bull. I love democracy. Again, I need to make these disclaimers because otherwise people will think I'm anti-America. America is amazing. I'd just be very careful about creating a single point of dependence through a rational economic structure. That is to say that if you're an individual, it's probably more rational to hold USD than it is, call it, emerging market local currency. And if everyone else comes to the same conclusion, this has second and third order consequences that might not be good for the world on net. So, yeah.
I think that's a great distinction, and it's actually very rarely brought up in the general discussion about stablecoins. And I think even though in the grand scheme of things, stablecoins, total market cap at $250 billion is a pretty big milestone, but also in the grand scheme of things, it's still very small. And we haven't really reached the scale where those types of problems are coming to the surface yet. But that it's going to be a discussion we have to have down the line, and it will have to be. It's going to be a tough one, I think, for individual countries that are trying to, one, simultaneously control their economies in the way that they want to, but also get access to this technology that makes things a lot more efficient.
Yeah, and not only is time getting faster, and as mentioned, the discoverability is becoming more programmatic. We didn't even talk about the scary examples. The scary examples are when it becomes everyone else in the world's problem, that there is collapse of some sort. And the craziest part is not only are there no circuit breakers built into these ledgers today, because it's international or multinational, who's to say who the governing body is, right? If United States vampire attacks, I'll choose a very scary, this isn't a great example, call it North Korea. Let's say the US vampire attacks North Korea. North Korea maybe has nukes. Who's to say who's right? There is no international court of judges that we all just agreed to give the outcome to. And that's when militaries might start to become involved, and more direct economic, maybe you could call it warfare, starts to become involved, and proxy wars because people have different interests. Maybe some support the United States, maybe some support North Korea. I basically think if we're not thoughtful about how this technology gets spread just beyond the super simple use case, which we finally agreed with on in a subset in Genius, issuance, right? If we're not thoughtful about what happens thereafter, and it's just blind euphoria, blind bull, there are patterns within these types of cycles. Leverage starts to build up. At some point, there's a deleveraging event, and one would hope that it's not. I'll call these problems that become everyone else's problem, as kind of like the main, I don't know if victims is the right word, but main recipients of these deleveraging events. And it's super hard for us to enforce privately, right? Because like everyone is competing with each other, and whether you're a builder, doing research, you're an investor, you're a broad supporter. Normally, regulation would come in and kind of like add these guardrails, but I almost wonder if like the world is fragmented too much and like data is passing between us too fast for there to be really great guardrails. And so, yeah, dude.
Yeah, it kind of reminds me of just like the lack of probably AI safety guardrails that are being implemented today. I don't think governing bodies can even really, not even if you're a domain expert, it's pretty tough to keep up with the information flow and like the changes every day. And so it is tough to be bullish on, proper guardrails being installed, whether that's for stablecoins or for AI or for just new technologies in general. I do think we're kind of lagging behind, even though we are making slow progress. But as you mentioned, even with Genius, we're only covering issuance, and that's perhaps not the most exploitable or most vulnerable aspect of this new chain that's being created through stablecoin. So that's a very good point. As we wrap up here, is there anything else about Sphere or new products, maybe touching on SphereNet, or anything else that you think that we missed that you would like to highlight?
Yeah, maybe I'll like wrap up that bearish bit with a more positive note.
That's always a great idea.
Yeah, as real as these risks are, people always bring up like nukes and how nothing horrible happened with nukes. And then one might be like, that's n equals one. But like all we can strive towards are like the good outcomes, and hopefully we're thoughtful enough to lead towards those outcomes. The beautiful part is that I do think there are several paths where we can be thoughtful as an industry about how this stuff spreads. And, underlying all of the manic bull posting, outside of New York and San Francisco, and you go to the emerging world, you do really start to see concretely, like physically flesh, right? Like people's lives are getting better in the interim as things like stable coins become more widely accepted. And so I think there's a large delta of prosperity that can be acquired as, the industry grows. And that's something to be super excited about. As a segue into things to know about Sphere, probably not worth diving too much into SphereNet just because that is a rabbit hole in of itself. I'd say if you're interested in making cross-border payments faster and cheaper, feel free to talk to us. We'll hopefully give you a good lay of the land. We're not best for every use case, but there are some use cases that I do think, I've yet to find someone better than us at, especially if you're oriented towards emerging markets, maybe more brick and mortar type of businesses. We tend to have a lot of war scars in terms of mapping out complex flows and kind of like doing the onboarding, everything from like, what is a stable coin to like, how do I think about on-chain compliance to how do I think about custody? Separately, if you're more kind of like curious about some of the topics that were brought up in terms of, maybe how should governments or ruling bodies think about this stuff? That is more relevant to SphereNet, and there are several active engagements that we're under now. So if that's interesting to you, I'd really encourage you to reach out to us, and we'd love to kind of like give you an overview of what conversations we've had so far and maybe some good ideas for thoughtfully building some of those guardrails in real time.
Awesome. Well, that was great, both from a technical and philosophical perspective. If our viewers want to find out more about Sphere or follow you, where can they go?
They can go to our website, spherepay.co or sphere.net. We're also on LinkedIn as Sphere Laboratories. On Twitter, we're at Sphere_labs or at Sphere. And Sphere is spelled SPHERE. And email is also great, team@spherepay.co if you have any inquiries.
Awesome. Well, Arnold, thanks for joining us today. That was great. It was a great episode. Really appreciate it.
Thank you for having me, sir. It's a lot of fun.
Awesome.